there's a set of people and firms that believe that the only companies that are interesting right now are companies with just a very strong AI why now. That was the wrong decision for a number of them.
Let's double click on that, because that's actually a very contrarian view right now.
2 out of 7 of the investments that we've made this year are very fast growing businesses, and they don't have a very strong AI why now. One of these companies has gone from 2 to 10 million of revenue run rate during the course of this year. Another has gone from $600K to a $12 million revenue run rate in like the last 100 days. And it's not because of AI, it's because they are, if you are just dogmatic that the only exciting companies are AI companies, you're missing out on some very interesting opportunities.
What is a consensus view in this age of AI investing that you think when we look back 10 years from now, most people would have gotten wrong?
That's an interesting question. I've never been asked that question before. So first of all,
hey climbers, welcome back to another episode of Climb by VSC. I am so thrilled to have on my guest today, Nikhil Basu Trivedi. Nikhil is the co-founder of Footwork, and he's been an early backer of amazing companies you know like Canva, ClassPass, and the Farmer's Dog. And more recently at Footwork has done investments like Anything, Confido, and Protege. I've always loved Nikhil's writing because he's so precise and thoughtful about what's working and what isn't in the current age of venture. So I'm so excited that we get to sit down and talk about things like how founders are building fast-growing AI companies with tiny teams, how you build a product that feels consumer but sells to enterprise, and how founders pick the right investor in today's hyper-competitive venture market. Nikhil, this has been a long time coming. Thank you so much for joining me.
thanks so much for having me, Jay.
I've been following and reading your stuff for years, so this is a real pleasure for me. Let's jump right into it. You've called consumer versus enterprise a false dichotomy. In practice, what are the best lessons from consumer that you feel like still work really well when you're selling to enterprise?
I've really despised how other venture firms, most venture firms, treat the world as consumer versus enterprise. You know, you'll have firms that have a consumer team versus an enterprise team. There's also a healthcare team, a dynamism team. The reality is so many of the great companies don't actually fit in the box of either consumer or enterprise. They are both. And in fact, the biggest companies in the world, the biggest technology companies in the world are both. The most interesting private technology companies, if you think about OpenAI with ChatGPT for consumers, with models for businesses, even SpaceX with Starlink for consumers, and of course, you know, payloads for businesses, are both consumer and enterprise. And so I've written quite a bit about this. And a lot of the companies that we love at Footwork are of this flavor, where they are both consumer and enterprise in their nature. To answer your question around what lessons companies can take that are consumer, perhaps consumer first, to apply to enterprise, I think the bar right now for just the quality of the user experience is really high, maybe higher than ever. AI is enabling these magical experiences to be possible. And so I think having that mindset that you have to have as a consumer business of a magical product experience, a jaw-dropping customer experience, having that mindset if you're also building for business users and for enterprises is very valuable and is perhaps one of the key things that differentiates you against traditional enterprise software or something you're rip and replacing, or perhaps actually the replacing of labor that's happening right now with a number of AI companies that are infiltrating the enterprise.
Yeah.
So to me, that focus on the end user experience is a core element that you can apply to both.
What's the end user experience in one of your portfolio companies, whether now or before, that sells to enterprise but really blew you away when you saw that experience?
One of the companies that we invested in earlier this year, it's called Confido, and it's building a AI financial operating system for CPG companies, CPG brands. So their customers are folks like Olipop and Feastables and Mush, a bunch of these new age CPG brands, but also Tropicana, Baskin-Robbins, some of the legacy incumbent CPG brands as well. What Confido does is it sells into the CFO, and so it is going top down, but it's a product that takes manual work in the CFO's office and automates it. And these are things like matching trade promotions and deductions to expenses, sales forecasting, and budgeting. There's a company called Anaplan that's a horizontal SaaS company. Confido is a little bit like Anaplan, but verticalized for the CPG industry.
Mm-hmm.
So to your question of magical user experience, even something like, you know, understanding how your promotions at Costco are actually doing and how your expenses related to selling into Walmart match your actual sales at Walmart, was this manual process that Convido automates. And it is incredible amount of time savings and cost savings for these finance teams. And then there's the chance to actually drive more revenue as a result of that through Convido as well. And so that's just one example of a company that's focused on the end user, the finance office inside of these CPG companies, and creating kind of a series of jaw-dropping customer experiences to help them save time, to help them save money.
Yeah, that's in the product itself. Have you seen any growth or marketing playbooks from consumer that you see work really well in enterprise?
There's a set of companies that are growing very quickly amongst enterprises that are product-led in their growth. So obviously, I was really lucky in 2014 to meet the team at Canva and invest in them in their seed round. And, they've grown organically amongst consumers and then prosumers and sort of bottoms up infiltrated the enterprise.
Yeah.
We have several investments at Footwork that are of this flavor as well. And so as an example, a company called Elicit, which is an AI product for scientific research. Elicit is being used organically by scientific researchers at a number of the big pharma and biotech companies. But what's happened is they've grown bottoms up to dozens of users inside some of these organizations. And that has enabled them to go have the conversation with the chief information officer or the CTO, the person who kind of runs software inside of one of these pharma companies, to say, hey, how do you feel about having Elicit across everyone on this particular side of the organization?
Yeah.
And now they're starting to sign those types of deals. So
can I challenge that assumption a little bit? Because I tend to find in that enterprise context, data and data security and what data you're able to feed into these AI products to get real inference and real insight out of it is sometimes like gated by CISOs and by product leaders.
Yeah.
How does a consumerized enterprise product show value when they're not necessarily able to get all of the enterprise data context?
Well, the benefit if you have people inside of a company already using a product like this is they're familiar with it. There's people who have perhaps hacked their way into finding value out of it. Mm-hmm. They're perhaps doing things with data they shouldn't be doing yet, but they're finding value out of it, which is why they're using it.
Yeah.
And so the benefit for a CISO is if you've got people already using these products, you can easily get feedback on what's working with it. And you may even be pushed by your employees to say, we have to buy this thing across the organization. And then by buying it, an enterprise license, for example, you have the control and the visibility that you wouldn't otherwise have with people just adopting these products.
Yeah.
But all of our companies that have this type of motion have to figure out a way to sell trust. And then usually once an enterprise purchases it, there's just a ton of extra benefit for having it be centralized, to be able to connect into proprietary data that the company has. And so the value actually becomes greater in like the enterprise version of the product than in the self-serve single player version of the product.
Yeah. On the kind of, let's call it road from 0 to 10 million ARR inside of these consumerized enterprise go-to-markets, what are one or two things that you've seen the founders that really succeed at hitting that ramp do really well that any founder listening should start thinking about doing today?
Well, typically, I think if you're going to scale as both a consumer and enterprise product, what happens is you grow very efficiently to millions in ARR. And I think a good sign that, hey, actually, this is likely to be an enterprise business is if you don't see that happen pretty organically, pretty efficiently in the early days. And sometimes that consumer, prosumer, self-serve growth takes you a very long distance. Canva's $3.5 billion of ARR, and I think about half of that is from consumer self-serve revenue today, and about half of it is from teams and enterprises. And so, you can get to billions in ARR if your product really sings, and if you have like a product-led growth mechanism that can scale. So I think my advice to founders out there who are building a business like this is focus on the product and the end user experience, focus on your product-led growth loops. And if you feel like you're nailing those things, it should be working. You should start to see it show up in the data in terms of referrals driving growth, a conversion rate from free to paid that is pretty strong, getting to millions in revenue, that's a signal that you're onto something that can be both consumer and enterprise, perhaps even at scale.
Yeah.
If you're not seeing that, then perhaps it's a good moment to reflect at some point to think about, actually, should this be an enterprise motion from a go-to-market standpoint? Like,
because there's education involved, or there's some data access involved.
Yeah, and by the way, we have examples of this in our portfolio. So, Felt, for example, is a mapping software company. It's a little bit like Figma for maps, and amazing way to create maps that can serve you for all sorts of use cases. So they have governments as customers that are mapping different buildings and other internal data on Felt. They're even exposing that to the public because Felt makes it very easy to share a map with somebody else. So you can go to a city government and see, let's say, like something such as all the parking spots or parking meters in an area, and click into that, and actually a Felt map will pop up. What they found, though, is that the real business is enterprise.
Yeah.
And so they still have a self-serve product. It's really great at top of funnel, getting people in the door. But the faster they get to a demo of the enterprise product, being able to connect your Felt map to a data store, which is a core element of the enterprise feature set, the greater the time to value is. And so they've really morphed from being a consumer and enterprise business, doing both self-serve and sort of trying to figure out upsell, to being very focused on enterprise from a product and a go-to-market standpoint over the last year. And that's really starting to work now.
Do you think it's important for AI products today to be multi-product in the first year?
It's a good question. I think that really big businesses typically have a single product wedge that's a fabulous wedge. And so, yes, there are certain products that, have to be more compound or maximally viable to be successful, to really find product market fit. But I think for the very best businesses I've seen over time, like there's typically a wedge that's a really great wedge.
It's a hero product, and then maybe features built around the
And then the best teams are able to very quickly move from hero product, single product, great wedge to multi-product, and to capturing more and more spend, more and more surface area inside of a company.
What I find with founders sometimes, and I don't know if you see this too, is the customer pulls them into a second product. And the challenge is sometimes, is it the second product is actually better? Is it we're doing it because we want to maintain the customer and the need, and we want to pull maybe some market share away from another tool they're using? Or is it that the hero product, that hero wedge, wasn't strong enough? And I always struggle with that because, when a founder calls you and says, hey, you backed us when we were doing product X, and now all of our time and energy and resources are on product Y. Should that be a scary moment, or is that just natural evolution in a company?
I think in some ways that's actually a great, exciting characteristic to see, because it means that the founders are learning and iterating and going to where the customer is asking them to go, and not just resting on their laurels on dogma for what's going to work in the market. So I don't mind that at all. Okay. I mean, I think I've seen several companies that I've been involved with just had such a fabulous initial product that they've still barely expanded beyond that initial product. And then others that have the characteristic that you just mentioned, which is the second product's actually the really exciting one that unlocks a much bigger opportunity.
Yeah.
So I think either way can work. In some ways we're in the business of funding and finding outliers. And so it's hard to pattern match when what you're looking for is an exception.
You had a great quote that I heard in another interview. We said, exceptional companies deserve exceptions.
Yeah.
And how does that ring true, or maybe not true, in this kind of current wave of fast-growing AI companies?
Yeah, look, there's a lot of tropes out there about how companies need to go from 0 to 2 million of ARR in 10 days. Actually, one of our portfolio companies did that. Or, if you're not growing more than 3x or 4x year over year, you're not interesting in this market. Again, I just think it's more nuanced than that. And so I still don't like to have benchmarks that I'm looking for in a company, or that I prescribe to a portfolio company to say, look, you have to be like this, or else you're not default fundable. I think it's just more nuanced, and it's the summation of the metrics of the business that make for something that's exceptional. And, I think what is true is that we're seeing more exceptional companies right now. I think in 2025, I've seen more companies that I've wanted to invest in than any other year in my venture career, which is an awesome thing to have.
Yeah. So in that instance where you're seeing that, when you're not swinging at the pitch, is that because you feel like that traction may not be sustainable? Is it that, you're expecting 5 million, but they're coming with 2? What is it that makes you go, well, I really like these companies, but I'm still disciplined about the ones I go after?
This year, while we've actually made more investments than in any other year, we've also probably said no to more quality companies than any other year. And hence why I reflect on the year to say, I think it's the best set of companies I've seen in my venture career. So why haven't we done some of the ones that we've also thought are interesting? The reality is, when you're just investing in a handful of companies every year, you're constantly having to prioritize the set of companies. And so there have been windows this year where we've been excited about 4 companies, thought that all of them are really interesting, but for one reason or another, we felt that one of those really spikes for us versus the others. Maybe it's just more in an area of expertise for us. Maybe it's the founder just feels like someone really special, or we think it's more N of 1 relative to some of these other companies that have a lot of competitors, and therefore feels like it's harder to stand out. So maybe we see something in that gets us excited about a particular opportunity. It's, again, hard to have one size fits all answer to this question. But I would say what I just tried to describe, those characteristics have been more important to us than the metrics. Because the metrics have actually looked good in so many instances this year.
Right.
So it's almost been like a check the box. There's clearly something here that's working. There's a number of really interesting signs of product market fit. And what we've gone very deep on then is the founder, that early team, to try to assess them. And then also on the market to think through, can this be really big?
Do you have a rubric or a couple of criteria for those companies where you come in and say, all things being equal, everybody is growing quickly, these are the 2 or 3 things that stand out to us for an exceptional founder?
Yeah. On the founders themselves, I think there's a little bit of, you just kind of see it, you feel it when you meet them, when you spend time with them, that there's something here that feels very special in terms of a founder's ability to concisely explain what they're doing, the vision for why what they're working on, is enormous. And so there's just like clarity of thought that can sometimes stand out and spike in a founder. There's a slope of learning that some founders just, it feels like they have.
How do you test for that with the slope of learning? Is it that if the founder doesn't come from the industry, how quickly they can get up to speed on it? Or are there other things?
There's little things that we try to pick up on as we're going deep with the founders. So I will often ask something like, tell me more about what you did the last few weeks. Just as a way to assess, like, how has their thinking changed, or what have they actually done? Try to suss out their slope of learning, velocity. I'll ask them, one of my traditional questions for many years has been, tell me about some of the highlights in the game film from where you started the business to where you are today.
Yeah.
And I just feel like the founders that have slope are able to identify, here are some of the key inflection points where the business inflected and changed, or my thinking changed. And they're just able to quickly answer a question like that, and they're able to answer it precisely.
Yeah.
Versus like, oh wow, that's an interesting question. I've never been asked that question before.
Yeah.
We love founders that are real students of their businesses, and so we're not having to educate them about something in the market. They know every player. They know ones from years past as well. Like, we're learning from them in the sessions with them.
Yeah.
So there's a bunch of stuff like that you sort of pick up on over the years to try to assess, is someone really exceptional?
I'll share one question I love when I'm digging in on market with somebody. I'll say, what is something you believed about this market that you changed your mind on since you've been selling into it? And it usually produces some really interesting combination of, well, when we started selling, we were doing this. And it wasn't, we realized actually that's not really the buyer. That may be the decision maker, but the buyer is somebody else, or the user is somebody else. Or we had this perception of this ICP, so we didn't even bother going to them. But as we started selling in, we realized actually this is the ICP that matters. It's some version of like, we went down this path, but we learned really quickly and we pivoted. And that pivot, whether it's just customer pivot or product pivot, is usually a really interesting signal to me that this is like, a founder that's going to move with the market, right?
Yes.
Sometimes you don't get an answer. They're like, no, it's the same. We're just going through.
Yes.
And then it's worth evaluating whether, it is actually true or if this is a founder that's not malleable in that way.
Yes.
On that topic, team, market, product.
Yeah.
How do you stack rank? If you had 100%, where do you put your weighting?
Oh, man. I think I weight team more than product and market. So probably team first, product second, market third. And so maybe it's something like 50, 30, 20 percent in each of those buckets. Why do I say that? Many of my great investments have been in markets that were not obviously great markets or big markets when the company started. But the company itself ended up creating a bigger market than they themselves ever dreamed of.
Right.
This is the case with the farmer's dog in the pet food space, where I think if I look back at that original investment memo, we led the Series A round at my prior firm in 2017. And the entire fresh pet food market was like hundreds of millions in the US annually. And today, the farmer's dog does billions in revenue annually. And so they themselves have expanded that market. And there's a set of ingredients, right? Like the trend of more and more people getting pets and treating their pets as humans that have also led to that market expansion. But I argue that the work that the farmer's dog has done is just as important as like the secular trends that have led to the market expanding. So I have been quite willing to take market risk or to invest in companies that were not in obvious markets that a lot of other VCs were chasing stuff in, where I and we at Footwork now have believed in a combination of the founders and the early signs of the product really resonating. That's how I have sort of always felt about it. Now, sometimes I've said things like I take product market fit ahead of founders and then ahead of market. But I think so much of this business and so much of building something that's absolutely massive comes back to the people. And so this sort of subjective analysis of the human is what I'm spending more of my time on today than perhaps ever before.
This farmer dog is a really interesting example because I think they started around the time that they weren't the only one doing this, right? There was Ollie and there was other products on the market. And as a dog owner, we tried all of them.
Yeah.
I'm very happy with farmer's dog.
Okay, good.
AI today feels a lot like that. I feel like almost in every vertical that I look at, there is at least 5 companies of varying degrees of pre-seed and seed funding, all going after the same problem.
Yeah.
How do you think about competition at this stage? How do you think about moats, or are there even moats in the world of AI?
I think that there are going to be markets that are just fabulous markets where a couple companies or maybe even more than a couple companies win. But I believe the power law will still apply where like, one or two companies capture a lot of the market winnings. And so obviously our goal at Footwork is to be part of those one or two companies in each of these categories. And we have really struggled with the level of competition in so many markets this year. We've just said we can't pick in several instances. But if you go back to the farmer's dog analogy, I think actually it does apply in many ways to what could play out in this current AI era. Because at the time we did the Series A, farmer's dog was actually less funded than Ollie, for example. It was a little bit smaller than Ollie in revenue. But what I felt very strongly about, and the reason why I wanted to make the investment, is it felt like the founders were just more obsessed with the customers than any of those other companies in the space. And by the way, I was open with all of them.
Yeah.
Hey, I'm going to meet everyone in this market and figure out what the right investment to make is, if there is one for us. So I actually got to have transparent conversations with a number of the players, and it just felt like Jonathan and Brett at the Farmer's Dog were more customer obsessed. There were little things that they were doing in the experience that felt different and felt like they were resonating with customers more than the other companies were doing. So like putting the dog's name on the packaging is this little thing that was sort of this surprise and delight moment for their customers. So way they were responding to customers through customer service, actually almost treating customer service as like a revenue generator versus a cost center, was quite unique relative to other companies. And then it just felt like that was showing up in the brand they were building that felt more authentic, more real than what others were doing.
Yeah.
So the conclusion was, this feels like a really interesting market. There's all sorts of reasons for why it could be a much bigger market 10 years from now than it is today. And while the Farmer's Dog isn't yet the leader in revenue or funding, it feels like it has a set of ingredients and genetics that could lead it to be the leader. And thankfully, that's played out. And they've really out-executed the competition on two dimensions, operations and marketing. I think this applies to a number of areas in AI because software development's becoming more and more commoditized. It's easier for anyone to do. So I think, marketing and brand may be one of the last remaining moats in this era. And so there's, I think, a set of AI companies that are really differentiating and winning based on that. And then the second one of ops, again, I just think there's raw execution required for getting any of these companies to scale. And so sometimes it's doing unscalable things to surprise and delight and satisfy customers that leads to that additional renewal and upsell. So I do think those are lessons that are applicable to a number of companies right now.
When you think about doing some unscalable things, I always think about margin and the margin impact of those things. We're in this AI era where you've got really smart investors from firms we know saying, actually, if your margins are too high, that means you don't have enough AI usage. And actually, we don't want super high margins. How do you think about that on this topic of growth, competition, and moats? How important is margin today?
Yeah, again, I think there's nuance to the answer. So I think for some companies, it's true that gross margin is a much less important metric than growth and retention. And so we literally said this the other day to one of our portfolio companies as they were thinking through the 2026 plan and what to prioritize. And we felt, look, like you're in a category that has a tremendous amount of market pull. It's pretty clear that the margins are going to get better because the main cost in their case is the cost of LLMs, and these models are getting cheaper and they're getting better and there are more of them to be able to play with. And so we kind of know that's going to go down. And so it doesn't feel like it makes sense for us to optimize on margins right now. Whereas, retention is super important and having customers be really happy. Of course, we don't want to give something away for, negative margins because then you're kind of, in some ways, you're faking the retention metric and the growth metric. But if margins are baseline okay, then it's really about retention and growth. I do think that a part of that's obviously informed by the capital markets environment that we're in as well, where, it feels like if you have growth and you have retention and you're building a category leading company, there's a lot of capital out there that you can raise. And so the margin question becomes less relevant if you can raise a bunch of venture capital to fund, not so great margins in the interim. I think that will change if the capital markets do change. But in some ways, this is reminiscent for me of 2015, where in consumer fintech a decade ago, there were a number of companies that had poor margins. And I actually analyzed my way out of some of the neobank companies and, others in consumer finance at the time because I was worried about the margins. That was the wrong decision for a number of them because it turned out we were in a capital markets environment that could fund these businesses, got excited to fund these businesses based on growth and retention, and was just less interested in the margins in that period. And so a number we're able to get to scale. So it's important to think about the macro as well, as I think you dole out this type of.
Yes. I mean, I think the D2C is also a good metric of this. There were some folks that were so reliant on Facebook marketing and Instagram marketing in the early days. And there were others that you would say, were default alive, right? You could turn that marketing spend down by 90%, and there was still a significant subscription business behind it. I think of Harry's and a few other, Dollar Shave Club at the time. They were spending a lot on marketing, but it wasn't unsustainable, right? And so there's something there with some of these AI companies too, especially for us when we look at dirty, dusty, and dangerous industries. They're selling into these legacy players where, it takes a little bit more marketing, it takes a little bit more education, a few more touch points with construction and manufacturing and transport, but it's an incredibly sticky product. And so I always have to, same as you, right? Like remove that side of my brain a little bit that's saying, is 40% margin sustainable? Can it get to 80 one day?
I mean, I think the other thing to think about here is these windows in time like we're in right now, where it just feels like so many companies are looking for an AI solution, are thinking about redoing, recalibrating their stack. These windows don't last forever. And so I do think we're in this unique window where every company is in evaluation mode, where you can go grab market share and you can go be very sticky if you are a fundamental product. And so I think that's part of what's driving the behavior on the marketing side, putting the sort of gross margin question aside for a second as well.
How long do you think that lasts? Is there a set timeline at which everybody goes, okay, I've picked my new AI stack and
it's
we're
a good question. I mean, I do think we're going to be in a world, and it's hard to know if it's 2 years from now or some other time period, but let's just say 2 years from now. I don't think that the word AI is going to be novel. Like, I think everything is going to be, and every technology company is going to be an AI company. And so, perhaps we're in a window for the next 2 years. Maybe it's less, maybe it's more, where it's novel to be an AI company and the AI native product in a space. And I don't think it's going to be novel a couple of years from now where everything is AI native. And so, I think we're in a unique window for the next couple of years. Hopefully it lasts, longer than that, or at least a couple of years.
I think there's industries where it's going to last a little bit longer. And I think some of these legacy industries that skipped SaaS but are now going after AI, I think that's actually the most exciting category to me. And there was, companies that I got burned on at my last firm where I invested, and now we've seen those things come back around with AI, and there's a lot more customer adoption, right? So you've been doing this long enough, and I've been doing a little bit less long as you, but I almost have to break my own mental model sometimes, especially when you've lost money in a category, to come back and say, am I ready for another go around on this, because the rules have changed to a degree. One of the things I really like about Footwork is that you guys invest both at seed and Series A. You don't see that as much with stage-specific firms. I feel like, mega funds and larger firms do that. How do you balance the two? I feel like it's a very different discipline at seed, pre-product market fit, and then at Series A when you're really thinking about size and scale. How do you split the responsibilities?
First of all, the nomenclature of these rounds has become kind of silly. I think I tweeted the other day, I appreciate that we're starting to call $6 million rounds Series A's again.
I saw that.
But we're also calling $20 million rounds pre-seeds.
Or whatever Mira Murati's doing at $2 billion.
Or a couple $1 billion rounds. So I think the nomenclature of these rounds is somewhat meaningless today. Look, the stage at which we really like to invest is when a company has some early signs that it's starting to really resonate with customers. So that typically translates into a seed, at least it perhaps used to. And certainly if it's not like a hyper pedigreed founder, someone who's raising $10 million plus off the bat, it can translate into a seed, or it's into a Series A. And we really like the flexibility that we have to go between those stages. There was a window where we were a little bit more skewed towards doing seeds. And actually this year we have done more A's. And so I think as a firm, in sum, we're a tiny bit more skewed towards doing Series A's as you look at all of our portfolio companies right now. And part of the reason for that is, back to what we were saying earlier, at seed, we found it really difficult to pick in a bunch of cases where there's 10 companies doing something very similar. None of them really have inflections of product market fit signs yet. And the founders all seem great and the market seems interesting. And so we have really wrestled with those decisions. Whereas in some of the companies that we have done and announced this year, Confido, for example, in the CPG category that we talked about earlier, Waldo, which is building this creative strategist for brands and agencies, a company called Anything, which is enabling people to easily build mobile apps and apps that they can actually turn into a business. All of these companies were doing a couple million in revenue run rate, a great set of early customers, early signs of inflection when we came in and led a Series A round. Mm-hmm. And that has felt like a much better place to play in the market to us this year than the seed pre-product market fit that actually may not be being done at that dissimilar of a valuation as well.
I'm glad you mentioned that last piece. That's actually been the toughest thing for me as a seed investor. I mean, seed is probably 80% of what we do, and then we play on the margins, the other 20%. There are companies that I think would be great companies at a 25 post that I'm seeing at 40.
Yes.
And to me, I think there's two challenges for the founder there. I'm sure you'd agree. One is there's no optionality, right? Yeah. The expectation for what your next round needs to be and the traction for that next round is that much higher. Yep. Seed 2 and bridges and all that stuff, like you don't have the wiggle room to go do that. And then the second bit of it is like, I'm not totally sure these founders know what to do with those quantum of dollars.
Yes.
And so they just end up overpaying or they end up overspending. Yes. And you get the same amount of value out of 5 million that you would have gotten out of 8, but now the threshold you got to go hit is higher. Am I wrong about that?
You're totally right. And real life examples, a couple examples that we've seen, companies that, did YC, raised post YC at 35 or 40 cap, and maybe the company was at, I don't know, hundreds of thousands in ARR. And they raised Series A's at 70 post, which is not dissimilar it's not much of a step up from the 40 cap. We would rather do the latter round. We would rather do the round when they've started to really figure something out that's starting to scale, given those risk rewards and those valuations. But I am really trying to find more stuff at seed to get excited about. It was funny because I think this year I was named to the Midas seed list.
I remember seeing that, yeah.
And I almost tweeted that day that, hey, this is cool, but I'm really struggling at seed this year. Like I want to do more seeds. And historically, my best investments have all been at 30, maybe 31 post and below. Wow, it's been hard to do that this year.
Yeah.
And so I'm hoping, I think that if you look hard enough, if there are founders that you have special access to, if you're willing to go into categories that are more on the edge of a new market versus something that's more consensus, you can still find those opportunities. But where even there's already something that's working, but they have to be a little bit off the beaten path.
Yeah. Conversely, to your point, right, where you're leaning a little bit more A, there's also firms, sizable ones, that are competing for those same ones. So how do you think about, at the A, convincing a founder to come work with Footwork when there's name your billion-dollar mega fund that also wants to compete for that round?
Yeah, and look, I think what we offer is a really different value proposition. So what we tell founders is it's two of us. That's the entire investment team. You get someone in Mike who's been a former company builder and operator. You get someone in me who's been an investor in a number of successful companies. We both are all in on what you're building. You're one of just a handful of investments that we're going to make this year. And we only do early stage. We only do seeds or A's. We're not trying to double down, triple down on the company. This is the round that we do. And there's going to be no signaling risk to you because we're not going to try to lead the next round. And then as our portfolio has started to mature a little bit, hopefully we have some success stories starting to develop that founders are getting excited to sort of be part of our brand and that speak for sort of quality if you're a Footwork investment. and a footwork portfolio company. And so those are some of the things that we try to sell to founders about why you work with us as your lead partner in one of those rounds. But it's a super different value proposition from, working with one of the big firms. And it just goes either way. And so, I think since we started the firm, we've won more than 2/3 of the companies that we've put an offer to. I think that maybe it's like 70 or 75% sort of win rate today. We have lost against the big firms. Mostly who we've lost to is the big firms. I think in every case, but maybe one or two. And it's because they are more excited about the big brand, or they're more excited about more dollars. Those are really the two main reasons. But where we have won against them is on just a very different proposition and approach. And then I do think some of the things that have gone in our favor is so many people leaving the big firms. And so if you're a founder that wants a partner that's actually going to be with you for the next 10 plus years and not just going to go leave and start another firm, which is something, by the way, that I did, we're an amazing potential partner because Mike and I are the founders of the firm and we are not going anywhere. This is our last job and it's our life's work. And that appeals to a set of founders.
Yeah. We saw this a lot in 2022 where I think 2020 through 22 where we saw that first wave of folks leaving, emerging manager spinouts. And I heard from companies that I had back where they just kind of felt orphaned on the cap table.
Yeah.
And it's a very tough position to be in because now you're educating somebody on your business who, inherited this thing and doesn't necessarily care about it, right? So I think it certainly matters a lot. On that kind of side of multi-stage firms competing for these companies, one of the things I hear from founders is, hey, I feel like I really need to get one of those guys in there because they might go king make one of my competitors.
Yeah.
And so is that something you've heard from founders as well, where they feel like just the quantum of dollars being thrown in? You start a voice AI company and suddenly Andreessen and Sequoia have already, tripled the amount of funding. You might have raised $10 million. They came out with a $30 million round in the same space.
Yeah.
The quantum of dollars being deployed into these categories, to me, I understand why a founder wants to go do it.
I get it as well. And so, yes, we have faced that in a few instances. I think that is more acute at the later rounds.
Okay.
Where, if one of those big firms is putting $100 million plus into a company, then it's a very real commitment.
Yeah.
That our argument is it's barely a signal to be the, X big firm backed company at just the seed. And again, some founders don't feel that way about it, but a number do. Look, history would tell you that who you raised the capital from and the quantum of dollars isn't the reason for your company's success. Of course, there's a set of firms that have been successful a number of times, but I would posture that it's much more about who they picked, and perhaps who they had access to in the founders themselves than anything that firm did for the company. And look, you saw with, the Vision Fund, for example, so many dollars going into a set of companies that was supposedly the king-made companies in a category, and a bunch didn't work. Mm-hmm. Some did, like, DoorDash was a great story of the Vision Fund, but you have WeWork in there. You have a bunch of stuff that didn't work.
Yeah, Wag versus Rover and
Get
all those
versus Turo.
Yeah.
There's a lot of these examples. And so I think that we don't believe that fundraising success is sort of company success, and those two are not equated. Of course, you have to fundraise so you don't run out of capital. Of course, it can be a strong signal, especially for hiring, to raise from branded firms. But the fundamentals of the business are ultimately what leads to, writing the S1 or not.
Yeah. I think raising capital as a defensive strategy has, again, become a signal of just the capital market that we're in, where folks want to go after market share. So they want to go raise the most capital so they can scoop up all the talent that they need to, or put it against marketing or whatever. And I've had companies in my portfolio that were the second player, but because they were more capital efficient, ended up being a returning outcome, as opposed to the guys that went and raised 200 million.
Absolutely.
And they weren't. And so that's how I sleep at night, is sometimes I just kind of think about it from my lens of like, hey, we're a $20 million fund. There's certain outcomes we need to be able to return the fund for our LPs. Yeah. And every time I read a competitive product raising, something with an extra zero after it, I don't know. That's how I rock myself to sleep. Yeah. Could be delusional, but I don't know. This has been so fun. I'd love to close with you on just a couple of things looking forward. What is a consensus view in this age of AI investing that you think when we look back 10 years from now, most people would have gotten wrong?
I think there's a set of people and firms that believe that the only things that are interesting right now, the only companies that are interesting are AI native companies with just a very strong AI why now. And I actually think there's a number of companies that don't have a strong AI why now, but are very, very interesting.
Let's double click on that. Yeah, because that's actually probably a very contrarian view right now.
I think it's a little contrarian.
Yeah.
And, 2 out of 7 of the investments that we've made this year are very fast-growing businesses. We've not announced either of them, but they're very fast-growing businesses, and they don't have a very strong AI why now. One is in consumer healthcare, and one is actually in the pet space, in pets and vets. And they're both playing into really strong secular trends. And of course, the companies themselves are leveraging AI in interesting ways. And over time, I think AI may be part of the reason why they're on the right side of history as a company. But the reason for why one of these companies has gone from 2 to 10 million of revenue run rate since we first met them during the course of this year, another has gone from 600K to a $12 million revenue run rate in like the last 100 days. The reason for those is that there's a ton of market pull for these products. And it's not because of AI. It's because they are sort of fundamentally interesting, compelling services for consumers in one case and sort of a B2B2C company in the other case. There's intricacies in these markets that are driving adoption. And so, we think that if you are just dogmatic that the only exciting companies are AI companies, you're missing out on some very interesting opportunities right now. And so that's part of how we've played the market this year.
Do you get concerned about follow-on capital risk, though? Because that's, I think, the biggest thing in my mind. And again, we're a stage typically earlier than you at seed, where the A-round guys that I talk to, the first kind of question is, okay, where's the growth? Where's the acceleration? Where's the first 100 days revenue? And if it's not an AI company, but is doing that, it's probably a unique instance.
Yeah, again, I think when you have something that's really working, that's what speaks for itself. And then per my comment earlier, I just think a couple of years from now, being an AI company is not going to be novel. And some of what's happening in the market today where companies are, because they're the AI native player in a space like ERP, they're getting valued at an absurd multiple of revenue. And that's not going to make sense several years from now when it's a technology company that, yes, it's an AI company, but that's all companies. And it's going to be valued based on how quickly it's growing in revenue and one day on its discounted cash flows. And so I do think that AI premium is going to go away in a few years. And if you're playing into a number of interesting trends, that there's plenty of opportunity outside of just purely thinking about the world as AI versus non-AI. The other thing I would say is, in some ways, it's because so much talent is going just towards AI. If you're building something that's really fast growing in something that's a little bit different, a little bit more at the edge, perhaps it's a little bit less competitive, and maybe it's easier to stand out as a category leader, as a category definer. So that's one of the other reasons for why I think it's an interesting way to think about the current market and to be a little bit contrarian, but hopefully right.
Yeah. If you have time for one more, I'd love to talk about your love for New York. So as a lifelong New Yorker, most of my friends in the Bay are like, Jay, everything's out here. I'll use myself as a personal example. I'm here 1 week a month because just the volume of companies that I'm meeting and want to get to spend time with in person. And you're doing the opposite. You're coming to my neck of the woods, and you've got a real love for New York. So in this AI era, why is New York exciting to you?
Yeah, look, I think San Francisco is an amazing place to live. I love being here, and it does feel like the center of gravity in technology right now. There are so many talented people moving out here. But again, I think part of this is my natural instinct to try to find things that are a little bit different, off the beaten path, not just what everyone else is chasing. I felt New York is an amazing place to build a company for many years now. And so many of the successes I've had in my venture career have been companies like Farmer's Dog and Frame.io, which Adobe acquired, Hinge, which is a dating app that does close to $1 billion of revenue. They're all New York companies, and actually ones that I wish I were in. Take Ramp, for example, New York-based company. And so there's just a lot of special people out there. I think the bar gets raised, as I talked about in this blog post, when you are around just really talented, ambitious people across every industry and not just in technology. Yeah. And so it attracts a different type of builder, perhaps. But I love it out there. And so 7 out of 23 of Footwork's CEOs are based in New York.
Wow.
We do have more concentration in San Francisco and the Bay Area than anywhere else. But New York is by far the biggest other market for us, and hope that we continue to see really special companies out there.
Yeah, well, I'm excited to do our next conversation back in my neck of the woods and have you on our New York studio. Nikhil, this has been so fun. I've been reading your stuff for so many years, and what a joy to get to sit down with you. So thank you for the time.
Thanks so much for having me, Jay. This was a blast.
That's great.